It's Saturday, and the week is in the books. The week that just closed handed you a pair of very different stories at the same time. Brent crude ripped more than 17% on the shooting war around the Strait of Hormuz. And the Nasdaq 100 dropped more than 4% in the same 5 sessions that the biggest banks in America printed record quarters. One of those stories says risk off, sell everything, the cycle is turning. The other says rotation, money changing seats inside a bull market that is still standing. They cannot both be the whole truth, and your portfolio only cares which one wins. So, this weekend review asks one question, and we're going to let the charts answer it piece by piece. Did the bull just crack, or did money just change seats? We'll walk it the same way every Saturday, what the week actually did. Whether the selling spread, whether money played offense or defense, whether the trend survived, and what the bond market, the adult in the room, makes of all of it. Weight of the evidence straight off the weekly charts, no predictions, just what is and the levels that would change it. Question 1. What did the week actually do? Not the headlines, not the scariest intraday print, the closes. Friday to Friday, off the weekly bars, because the index number you saw on your phone is hiding most of what actually happened underneath it. Start with the S&P 500 weekly chart. The prior Friday, it closed at 75.75. This Friday, 74.58, down about 1.5%. The week's high was 75.81, the low 74.31. Remember both numbers because they are this entire video's framework, and we will come back to them at the end. Now the Nasdaq 100, same weekly view, and this is where the damage lived. From 29,825 down to 28,593. That is more than a 4% weekly decline, and at the low, the index touched 28,231 before buyers showed up. Tech fell nearly 3 times as hard as the broad market. Drill one layer down and it sharpens. XLK, the technology sector fund, lost 5.5% on the week, closing at 175.59. And understand how the week was built, because the calendar matters. The war premium arrived Monday. Strikes on Iranian sites, retaliation across the Gulf, blockade talk on the tape before the open. But the tech damage compounded Thursday and Friday on earnings guidance and AI headlines, not on missiles. Different shocks, days apart, landing on the same index. Now the Russell 2000, the small caps, 2978 to 2962, down about 0.5%, basically flat. 2,000 stocks with the most domestic exposure, the thinnest balance sheets, the names that panicked first in a genuine risk off, and they barely blinked. And the fear gauge. The VIX went from 15 to 1876 on the week, up about 25%, with a high at 19.5. Elevated, absolutely. Moving, absolutely. And it never closed a single session above 20. The line where hedging turns into forced de-risking. So the scoreboard reads, tech hit hard, the index dented, small caps flat, and fear rising but contained. That mix is unusual. And it is exactly why the next question decides everything. This question, did the selling spread? Every correction in history starts in one corner of the market. A crack becomes a break the day the selling stops being selective. So, did it spread or did it stay in its lane? This is the chart most people never look at. Equal weight S&P versus cap weight, RSP over SPY, weekly. Every stock in the index counted once, divided by the index where the giants count most. When this line falls, a handful of mega caps are carrying the tape, and the average stock is along for the ride. When it rises, the average stock is doing the work. This week, in a down tape, the ratio rose more than 1%. Sit with that for a moment, because it is the single most important fact of the week. The index fell 1.5%, and the average stock inside it went UP relative to the index. Mechanically, that means the selling was not the whole index. It was concentrated at the very top of the cap table, the mega cap tech complex, the exact handful of names that had carried the index for months and where every crowded dollar lived. Cross-check it with the small caps you just saw. The Russell gave up 0.5% while the Nasdaq gave up 4%. Run the falsification test. If this were a genuine risk off, a growth scare, a credit event, a liquidity problem, the pattern inverts, small caps lead the damage, equal weight collapses against the index, and the generals fall last. That is what every real bear phase looks like at the start. The opposite printed this week. The soldiers advanced while the generals retreated. In the weight of the evidence, that is not what breaking looks like. That is what rotation looks like. But rotation has a destination. Where did the money actually go? That is the next question. The next question. Did money play offense or defense? Rotation always leaves fingerprints. One sector's outflow is another sector's bid. Follow the fingerprints this week left on the tape. First fingerprint, energy. XLE, the energy sector fund, weekly. $55 to 57.68, up almost 5% in a week when the index fell. With Brent up 17, the producers confirmed the move, and confirmation is the word that matters. When crude spikes but the producers don't follow, the market is telling you it doesn't believe the price will stick. This week they follow with force. The war premium is flowing straight into the earnings of the companies that own the barrels, and money chased it. That is offense, aggressive, directional offense in one specific sector. Second fingerprint, the consumer. Discretionary versus staples, XLY over XLP weekly. Down almost 3%. Money rotated from want to have toward need to have. From restaurants and retail toward toothpaste and groceries. That is the classic defensive fingerprint. The one that says portfolio managers trimmed risk without leaving the market. Third, and this is the chart of the week, semiconductors versus the S&P, SMH over SPX weekly ratio. Down 7.5% in 1 week. Chips did not just fall, they fell 7.5% faster than the market itself. And here is what makes that violent number readable. The news inside it was good. TSMC grew revenue 36% year over year and raised its capital spending plan towards $64 billion, and the stocks got sold anyway. When good news gets sold, you are not watching fundamentals break. You are watching positioning unwind, crowded money leaving a crowded theater through a narrow door. The fourth fingerprint is the one that did not print, and it might be the loudest. High yield credit versus treasuries, HYG over IEF weekly, down 0.3%. Flat. Credit is where real trouble shows up earliest. Junk bonds reprice hard and fast when the market smells default risk, and they do not wait for equity's permission. This week, while tech bled and missiles flew over the Gulf, credit did not move. So the four fingerprints read: offense in energy, defense in the consumer, a violent unwind in chips, and total calm at the exit doors. That is a market changing seats, sector by sector. It is not a market running for the exits. Now the trend question. Is the primary trend intact? A bad week inside an uptrend is noise. Every bull market has dozens of them. A bad week that breaks the structure is signal. The weekly chart settles it, so let's look. Back to the S&P weekly and now read the structure instead of the week. The index closed at 74.58, down on the week, but it held above the week's own low at 74.31, and the weekly uptrend that built through the spring is still standing underneath it. One down week of 1.5% after the run this index has had does not break a weekly structure. It tests it. Tests are normal, failures are not. And the difference between them is one number. A weekly close below 74.31 is where this stops being a test and starts being a change of character. Watch weekly closes, not Tuesday afternoons. Intraday breaks that recover by Friday are how this market shakes out weak hands. Now the other trend on the board, the one that is accelerating. Brent crude, weekly, 75.22 to 88.27, a 17% week, high at 88.38. And here's the part the headlines skip. The week before, oil was already up more than 4.5%. The market was pricing Hormuz risk before Monday's strikes ever happened. This week poured fuel on a fire that was already lit. Two weekly bars, both up hard, both closing near their highs. That is trend, not spike. And trends in crude have a way of beating themselves through hedging and short covering. The strikes came Monday, the blockade talk came with them, and then Tuesday the transit fee proposal was withdrawn, with Bloomberg reporting flows easing along the waterway. Crude barely gave any of it back. When a market refuses to fall on de-escalation news, the premium is sticky. One more read rounds this out. The dollar index was flat on the week, down 0.2. No dollar squeeze, no liquidity event hiding under the surface. This is a clean head-to-head race. Equity trend bent, but intact above 74.31. Oil trend up and accelerating through 88. Those two trends are now pulling on each other, and there is a referee. Which brings us to the bond market. The last question. What does the bond market say? An oil shock is supposed to be an inflation shock, and an inflation shock is supposed to show up in yields within hours. The 10-year Treasury is where the fear has to appear. Did it? Here is the 10-year yield, weekly. The week oil rose 17%. The 10-year went from 4.56 to 4.55, 1 basis point. LOWR, the single most inflation-sensitive price on the planet, looked at the biggest oil week of the year and did not move. Why not? Because the same week delivered the other side of the ledger almost hour for hour. Tuesday morning, June CP. I printed 3.5 against 3.8 expected, a cooler print, with core at 2.6 and core month over month at 0. Wednesday, producer prices actually fell 0.3, with the energy pipeline components falling hard. Gasoline down 12% inside that report. The bond market netted a shooting war against the cooling inflation trend and called it a wash. And the pricing tells you which way the room leans. Reuters reported markets putting only about a 14% chance on a July hike, with roughly 30 basis points of hikes priced by December. That is a market debating whether policy needs to lean harder, not one bracing for an inflation spiral. Then get another opinion. Gold, weekly, with missiles in the air and a blockade on the front page. The oldest war hedge in the world fell about 2.5%, closing near 4,018. CNBC called it the biggest weekly loss in 6 weeks. Read those together, because this is the spine of the whole review. No fear bid in the metal, no fear bid in bonds, no stress in credit, no squeeze in the dollar. Outside of the equity volatility complex, the deepest markets on earth looked at this week and refused to panic. Either every one of them is wrong at the same time, or the equity move was never really about the war at all. So, the verdict question. Every answer is on the table. Weigh them together the way a portfolio manager has to, should you walk into Monday confident or concerned. Here is the honest tally. Both columns, nothing hidden. The concern column is real, so give it its due. Semiconductors lost 7.5% against the market in 5 sessions. Unwinds like that can cascade if the crowd all runs at once. Technology, the largest sector in your index, fell 5.5%. The consumer rotated defensive. The VIX rose 25%, and a 17% oil week is an inflation risk with a lit fuse. If crude keeps climbing, the bond market's column gets tested week by week. Now the confidence column, the average stock went UP against the index. Small caps barely fell. Credit did not move. Yields did not move. Gold went down. And fear never closed above 20. Weigh them honestly and a pattern jumps out. Everything in the concern column lives inside one complex. Mega cap tech and the AI infrastructure trade, where TSMC's own spending plans and a guidance stumble at Netflix handed crowded money its excuse to leave. Everything in the confidence column is the rest of the entire financial system. Bonds, credit, gold, the dollar, 2,000 small caps. Declining to confirm the scare. Weight of the evidence as of Friday's close reads, a concentrated unwind inside the market's most crowded trade, funding an orderly rotation into energy and the average stock. All of it under a real live oil shop overlay that the bond market is so far refusing to price. That is not a broken bull. It is also not an all clear. It is a market on watch, and the next few weekly closes decide which column grows. We do not predict which. We mark the levels and we let the tape flow. So here is your map for the week ahead. 3 lines, 3 scenarios, and every line comes off the weekly chart. Nothing here is a forecast. Everything here is a trigger. Start with the S&P above 75.81, the week's high. The base case resolves bullish. The dip got bought. The rotation thesis wins. Tech found its floor, and the unwind goes in the books as a positioning flush. Below 74.31, the week's low. The escalation case opens. The unwind is spreading beyond tech. The weekly structure that held all spring is failing, and the conversation changes from rotation to distribution. Between those lines, everything is noise. And noise is exactly what a Tuesday headline out of the Gulf will try to sell you. Oil is the other dial. The line is 88.38, the week's high. A weekly close above it says the supply premium is still building, and the inflation question comes back with teeth. That is the scenario where the bond market's patience finally gets tested. A slide back under 80 says the premium is bleeding out, de-escalation is being priced, and the whole board breathes. And the calendar decides which door opens. Wednesday, Tesla and Alphabet both report the names that can answer the AI spending question that started this entire unwind. If their capital plans and their guidance hold up, the semi-story gets rewritten fast. Thursday, the European Central Bank decides. Friday, flash PM. IS land and the 10% global tariff expires. Bloomberg reports Washington racing to replace it before the deadline. Watch that one, because tariff headlines feed straight into the same inflation math the bond market just shrugged at. The Fed itself is the week after, on the 28th and 29th. One more time, because it is the whole video in 3 lines, 75.81 above, 74.31 below, 88.38 on crude. Everything else is commentary. That's the weekend review, the debut edition, same time every Saturday. A 17% oil week that the bond market refused to fear. A 4% tech drawdown that the average stock refused to join. A trend that bent, held its low, and walks into Monday with 3 lines that settle everything. Quick recap so you walk in ready. The unwind was concentrated in the crowded trade. The rotation was orderly. Credit and bonds and gold all stayed calm. and the levels are 75.81, 74.31, and 88.38 on Brent. Watch weekly closes, not headlines. No predictions, no positions, and none of this is financial advice. Just the numbers and the levels straight off the weekly charts. If this saved you a weekend of scrolling, subscribe. The review drops every Saturday. Let's walk into Monday ready.